Welcome to the Mike White Podcast, episode 4. Today with us is Vyom Joshi. He's out there in Portland, Oregon right now. He's an electrical engineer, a value investor, and the founder, managing partner of Superior North LLC. Just a caveat for today's episode, this is not investment advice, purely for educational and entertainment purposes only. Vyom, how's it going?
Hey, Mike, thanks for having me on. It's going
Yeah,
good. It's going good. I'm excited to be here today.
it's a pleasure having you. So I'll start off with the roots of your roots. So how did you get into investing? Like what piqued your interest?
Yeah, it was back in high school. I took my economics class and we had to create a portfolio of companies. And that's when I got started. I had to pick like 3 stocks and track the stocks throughout the semester. And then at the end, we had to show where the stocks were. And during that period, I had to do a bunch of fundamental analysis and try to figure out how good the stocks are based on those characteristics. So that's how I got started into stocks. And then the rest is history. I got into like technicals and then into fundamentals and eventually realized that I'm a true value investor. And but it all got started in high school.
Yeah, so what brought you to value investing? Because there's a lot of different methods,
hmm
and I mean Warren Buffett, everyone knows his name, probably the most successful investor of
hmm
all time. What got you
Right.
into his method?
Yeah. So I think all of us at some point in time want to make money really quickly, and we're impatient. And that's what happened to me. I was into penny stocks at first. I'm like, okay, this is so good. Like, because I was working with little to no capital, and I was like, what's the best way to make the most amount of money? And I was like, penny stocks it is. And then I got into like technicals where you're looking at charts and analyzing, drawing Fibonacci sequences, and then looking at supports and resistances, and when is it oversold or overbought. And there was no like uh, method or understanding that what I'm buying is actually a business. What I was buying is just a chart, I guess, that looked pretty. And so I took an L on that one. I was like, okay, this is not working out for me. And then eventually it was into value investing when I came across the Investors Podcast,
Really?
which
Okay.
is another value investors podcast. And that's how I kind of got introduced to Charlie Munger and Warren Buffett and their methodologies. And then I got into Buffett books and then started learning more about Warren Buffett. And then his proven record, right, for 60 years that guy has, he's not here for 2 or 3 years and then is forgotten. He has been here constantly outperforming the market. And so eventually made him my mentor or my guru. And
Yeah.
uh, the rest is history. So that's eventually how I navigated into value investing, where it resonated with me, understanding that what I'm buying is real businesses. They're not just stocks or what's it called? Just something that's floating around on your ticker screen, that what you're buying is the true business. So yeah,
And
it
there's a
aligned
lot
with
of
me.
yeah, there's a lot of data and like technical stuff that I wish I knew. I
hmm
mean, I want to learn sometime um,
hmm
that goes into value investing. A lot of analyzing. I see in
hmm
your videos for the Superior North, a lot of you do analysis on certain stocks and if you think they're a good
hmm
buy or not. And a lot of times you talk about this discounted cash flow analysis. I
hmm
don't know if you
hmm
want to get into that at all. If you can kind of just give a
Sure.
little peek intro for
Yeah,
our listeners that really have no
of
idea of
course.
what investing is.
Yeah. So discounted cash flow originally came from John Burr Williams. So there are various ways of finding out if a company is undervalued or if to figure out like what's the true value of a company. The two biggest ways are either you do absolute valuation or comparative valuation. With absolute valuation, you're looking at, okay, what is this company that I'm looking at, specific company worth? And with comparative, you're looking at, comparing that stock with other peers within the sector. So focusing on the absolute valuation, that's where intrinsic value comes in. And there are various ways to derive intrinsic value, but the one that Warren Buffett uses came from John Burr Williams, which says that to find a value of the company, it's going to be the cash flows that the business is able to generate every year from now to perpetuity, and you discount it back to the present value. So what that means is, let's say you have Apple that's, let's say, trading at $100, and Apple is generating, that Apple's going to generate $100 of cash flow next year. So, you can think of it as Apple bringing in $100. And let's say you want a 10% return on that stock, which is considered the discount rate that you may apply. And discount rate is pretty much the return that you want to get on that investment. So you get to set whatever you want. If you want 15% return, you set it 15%. Most investors set it at 10%. And all that means is, if I want to buy in the security, I want to get at least a 10% return. So you discount that $100 back to the present value. So you would have to buy it at about $91 to get that 10% return, because next year it's going to be at $100. So you won't technically buy it until Apple stock gets to $91, which is when you'd say, okay, this is getting to the return that I want to get to. But long story short, right, without getting into too much nitty gritty, it's essentially you're looking at what's the business is going to generate as far as cash flows are concerned. Today, tomorrow, day after tomorrow, you bring all of that back to the present value at a certain discount rate. And that's how you know that, okay, this is what the company is worth. And then you compare that worth with the company's current market cap and see that, okay, if let's say Google is $1 trillion and I value it at $2 trillion, then I know that Google is undervalued. So it's all, the hierarchy goes to the absolute valuation. You're not necessarily comparing Google to other stocks or other companies. You're looking at Google just by itself.
By itself. And so this type of analysis and just information in investing, I know probably, a majority of the investors that, just do it on the side or on Robinhood, no one's even heard of this, or they don't know anything. And if they wanted to get into it, and I feel like that was kind of Buffett, from what I've learned from him, is he was huge into just learning, reading, networking. It sounds like you have that kind of similar inkling inside of you. Is that something you had to kind of push yourself to do, or is it just inherent that you were always curious and wanting to learn all about the ins and outs of investing?
Yeah, I think it's some regards has to be inherent. Like it has to come from within you when it comes to knowledge acquisition, because that to me is the biggest thing. To me, I'm like always learning from Warren Buffett or Charlie Munger, whoever you look up to, like how do they live their lives? How do they conduct themselves? How do they get better? And I just clone and follow their footsteps, that, okay, this is what he says is a recommended read. I'm going to read that. Or this is how he says one should conduct their lives. I'm going to learn to do that. So it's, I think up to some regards, it's inherent, but then you can push yourself as well, because when it comes to human cognition or human behavior, everyone's curious up to some regards. We're always Googling something or the other. You just have to figure out what you're truly curious about and pursue those interests. And for me, it turned out to be value investing, becoming a better person, learning more about human behavior, investing, how it all relates together. So yeah, and I'm still learning. I don't think I'll ever get to a point where I'll know everything.
Yeah, it's impressive though. I saw everyone should check out your website at Superior North LLC, and there you have your a list of all the books you recommend, and you have a top 10. And there's a lot of books other than just the top 10. But your number one book on there is actually a book about, it's called Leadership in Turbulent Times by Doris Kearns Goodwin. I've never heard of this book, and it doesn't sound like it's about investing. Why is that your number one?
Yeah, so that's a good question. So that book is about 4 of our past U.S. presidents, the 4 being Lincoln, Teddy Roosevelt, FDR, and LBJ. And it's about the struggles that they faced in their personal and professional lives, the setbacks that they had. And despite those setbacks, they persevered and, led the country through turbulent times. Like Lincoln, of course, I think everyone's aware of the setbacks he has had in his personal and professional lives, all the failures that he has had, and still led the country through Civil War. With Teddy Roosevelt, he lost his wife and his mother on the same day. Both of them passed away, and it kind of pushed him into depression, had to go to the Badlands, recovered, and then led the country again through the trusts, and pretty much brought the voice for the average Joe who were pressed down by monopolistic powers. And then we had FDR, who came in, who had polio and with crutches, and it was later in his life that he had those setbacks, and then same with LBJ. He had a heart attack, kind of pushed him back in his career, and then came through. So I think the reason I liked it so much is because it gives me hope that if people like these have persevered in their lives, the setbacks that I face every day, that's nothing compared to what these people had to go through, and yet they pulled through. So it's more of an inspiration, and you learn a lot from them too, because these were great people that you can always look up to. They're more or less the friends that are eminent dead. I always like to have them around.
Yeah, that perseverance, I imagine that's huge in investing, because especially like right now, you look at the stocks and the everything is just red, everything's going down, everything's taking a hit, and that's probably, looking as an outsider looking in, that would probably be the most difficult part, is like not to let your emotions get the best of you and just start selling off everything. I don't know if you have any tips, or is it because there's the analytical part and it seems like there's also a behavioral emotional part.
Yeah.
How is it, 80-20 you think, or 50-50?
Yeah. So there are three biggest ideas that every value investor has. The first is, like I briefly mentioned, where you think about stocks as businesses. They're not, something that's floating around on your on the ticker screen. So that's the focus. That okay, just because something's cheap or something dropped in value doesn't mean or dropped in price doesn't mean it dropped in value. Google may still be a super valuable company, even though it's down 33% or whatever it may be. It hasn't lost its moat. So thinking about the thought process that just because something is down doesn't mean that the business is now bad. In fact, it's cheap and it's a good time to buy because you're getting it at a discount. So that's one of the ways that you can look at it. The second one is always having margin of safety. Is the other thought process that value investors have, that because when you buy something as a value investor, you always have to take into account that what's my downside? How much am I protected? Because the last thing we want is to lose money. So that's the other concept. And the last one is, what's it called? Mr. Market, which is what you briefly talked about, that, the stock prices are going to go up and down, and Mr. Market, who is the stock market, is there to serve you and not to instruct you. So when you see a declining market, that's the best time to buy, because you're going to, quote unquote, abuse Mr. Market. You don't want it to be the other way around, where Mr. Market tells you what to do. You have to decide on, okay, is he giving me a good deal right now? And if he is, then you have to act and buy. Those three concepts are so ingrained as for value investors, that a down market like right now is, I'm looking and I'm like, oh my gosh, I'm getting great deals right now with certain stocks that I'm interested in. So yeah.
I guess if you detach and you kind of look at it in the big scheme of things, you can kind of get over the temporary downturns. But the other thing I wanted to see your opinion on is, I always thought investors and bankers get a terrible, they just get attacked really unjustly. Like you think of they call them robber barons versus captains of industry. And I think creating wealth is super moral and noble, because in a true free system, you only will make money if you're providing value for somebody else, or perceived value. And most of the time it's probably right. Sometimes people will spend their money and realize, oh, I probably won't do that again. But for the most part, and then with investors, the investors are maximizing the use of the funds. So if you invest in bad companies that aren't providing people value, then if you just keep giving them money, they'll survive. They'll just be zombie companies and just wasting away all that productivity and really just hampering human flourishing. And I think investors and bankers are vital to that role. I don't know if you agree, or you feel like they're greedy.
Yeah, I think I'm a big Adam Smith fan, and I think that capital flows wherever it's most needed and where the society thinks that so society is going to value stuff that's really critical and important for civilization. It could be, some kind of cure, some kind of medication, some kind of technology advancement, and the investments that the money that those causes are going to get is going to be a lot greater than something that's not as impressive. So it truly depends on the society what it deems is important at certain times, and all the attention and the needs, the capital needs that those causes have, are going to be fulfilled because that's what the society needs to flourish. In a way, you can also think about it as the invisible hand, always there, which will eventually balance everything out. And then at the same time, when it comes to greed, yes, it's greed and envy are the two biggest drivers when it comes to any kind of craziness or bubbles that erupt, because everyone's trying to get rich quickly. And in doing so, you are going to have bubbles. And it's just in our nature, and the best we can do is know that, are we being greedy? Are we being envious? And when it comes to greed, you're being greedy at times. And when it comes to envy, I think the best thing that we can do is what Aristotle says is you have to deserve what you are envious about. So if you think you want to become a billionaire, but you haven't done anything to become a billionaire, then that's how you get rid of envy. You shouldn't be envious because you haven't done anything to get to that goal. So
you haven't earned it.
It's yeah. So yeah, it's our natural impulses to become rich, become powerful, be greedy. That yes, it all ties in hand. It's amazing what people can do.
I think, ultimately my overview is, I think Warren Buffett should be, is a noble person and praised for how much profit and value he's added to the world, and that they do play vital roles. And so, talking about your people getting greedy or mistakes in the market and stuff like that, is there anything lessons learned that you've had in you haven't been an investor for too long, but any big lessons learned for people starting out?
Yes. I wouldn't say this is what I've learned from others' mistakes, more or less. The first one being
that's the best. That's the best kind.
Yeah, that is the best kind of mistake. Inversion is one of the concepts that's not necessarily technical. It can be applied everywhere, which I think is important, even in investing. Is if you want to become rich, if you want to get more money, the best thing you can ask yourself is just invert that question: is how do you go broke? How do you lose money? And all you have to do is simply avoid those things. And when it comes to investing, the one biggest way that people go broke is leverage, using other people's money, taking on debt to magnify your results. And that's the biggest one. Where how do you go broke? Leverage is one of the biggest ones. So just don't ever lever yourself. Never take on debt. Use borrowed money to make your bets, and you're going to be fine. And then having the temperament is the other big thing, where just because something is down doesn't mean that the value has totally deteriorated. If you thought that something was good yesterday and today it's selling at 10% discount, then in fact you're getting a better value and you should be buying, not necessarily selling just because it's losing right now. So those two, temperament, having the correct attitude and the thought process. Don't think about stocks as something on a paper or on your screen, but rather when you're buying something, it's a business. And that isolates yourself from impulsively selling or buying things just because you may be emotionally driven, when this kind of helps you isolate yourself from those emotions, because you know that what you're buying is a true business. So, yeah. Awesome.
And so how would you recommend someone that wants to get in investing, say that they're working a full-time job just like you were and you are, and in their free time when they come home from work? What's the best thing they can do to build their knowledge?
Yeah, I'd say audiobooks are great now. I like to read, and podcasts are great too.
What are your top podcasts? Top three?
Those top three. Not all of them are business heavy.
Okay.
I like Philosophize This. I like Huberman's Lab. I like what's it called? MarketWise. It kind of gives me in the morning is what I like to listen to. It gives you a bigger picture of everything that's going on. I like to listen to the Memos by Howard Marks. I like Monish Pabrai's talks that he has. So Monish Pabrai is another value investor. So is Howard Marks. They're both value investors that frequently talk about investing, the macro environment. Monish Pabrai, he usually goes or gives lectures to students on value investing. So yeah, those five I'd say.
Yeah, I really love podcasts. I have to say, I was a big reader, and it does bother me that I can't do anything else while I'm reading, and sometimes my mind will drift. But podcasts, I feel like I can just play those throughout the day and just kind of soak it up.
Right.
Which brings me to the Investors Podcast. You said that's what you got started in, and I only recently heard about it, probably a couple of years ago. My buddy texted it to me when it was actually when he was telling me about Bitcoin. He started sending me that. But one person I look up to there is Preston Pish, and I know you have a story about you somehow like asked him a listener question, and I was just wondering how that happened.
Yeah, so Preston Pish and Stig, I met both of them at the Berkshire Hathaway shareholder meeting in Omaha in 2018, and phenomenal guys, really knowledgeable, very down to earth. So it was great to see that the podcast hosts that I listen to are just as awesome in person.
Yeah.
And then the question that I asked, I think, is how they became. Back then, I don't know if they have it right now. I don't really listen to the Investors Podcast these days. But back then, it was they had the thing where you can record your question, and then they would, if they liked it, they pick it, and then they play it on the podcast. And I think, if I remember correctly, I asked something along the lines that how they became partners and how that journey kind of happened, who reached out to whom, and all of that sort of thing. So I don't remember what their answer was, but that's the question that I asked.
Do you remember what episode it was on? I wonder if we can find it in the archives.
It was January of 2018 or 2019. It was one of the first episodes. It was the one with Michael Dell. So that's all I remember. It was Michael Dell episode about him, and at the end was my question.
So now I'm interested in this Berkshire Hathaway meeting in Omaha. How is that? Is it worthwhile?
Yes, it's it's amazing. Like the kind of people that come. It's so diverse. It's not just business folks. It's people who are in hotel industries, or what's it called? Doctors are there. Engineers are there. People who are architects or poker players. Like it's all kinds of people show up, and all they want to do is knowledge acquisition. Like they're just there to be in the presence of Warren and Charlie. It's more or less a cult. They call it the Woodstock of capitalists. So it's they're there with that thought process that, hey, I'm going to learn something new today. I'm going to meet some amazing people, not necessarily there to show off their wealth, show off how much money they have, or any of those kind of things. It's very down to earth, and it's great to network and meet people. So I went back again this year, and I met 4 or 5 people that I met in 2018, and it was just amazing catching up. It's like we met, but it's like we never were away for 5 or 6 years. And I would definitely recommend you go. You don't have to be a value investor. All you need is a share of Berkshire Hathaway. Class B is okay too. I'm not in the position to afford a Class A share, which trades at about $450,000.
Wow.
Class B is about, I think, $250 to $60 a share. So a
Okay.
lot more affordable. Yeah.
And is it so? It sounds like you have a lot of time to meet the people and talk. Or are they also like
hmm
speeches that go on throughout the day?
So the actual meeting is on Saturday, and that's when Charlie Munger and Warren Buffett and answer any questions that shareholders have about anything. It can be about Berkshire Hathaway, it can be about life, it can be about what do they like to do. It can be anything about. So it's amazing to see the questions they get to ask and the replies to their questions. Sometimes can be entertaining, and so I mean these two dudes, one's 92, one's 97. They're super old, but yet they have this amazing personality that just draws people in. And then so that's just on Saturday. Saturday for about 6 to 7 hours is they take all these questions. On Fridays, Friday night, there are other events that people go to and network. Saturday evening, they have a picnic that's Berkshire sponsored. And so it's more networking after the meeting. And then on Sunday morning, they have the 5K Berkshire Hathaway run. So it's called Invest in Yourself, where it's all about health and well-being. And then there's the Markel component or Markel brunch after that. So it continues for like 3 days before, 3 days after, and then Saturday is the main day. Long story short. So
That's awesome.
yeah,
I'm
yeah,
amazed. Two guys in their 90s up there all day just answering questions. Like, gosh, what
yeah.
they got some motors on them.
Right. So I think someone even asked, like, I need to learn the secret of your bladder control or something along those lines. That I don't know how you do it, and
They have
I think they
diapers. Is it
jokingly
diaper?
they jokingly replied something that I don't remember, but it just cracked everyone up.
Do you? I've been to just a few. I've never been to that one, but conferences where people do the Q&A, and
hmm
I just get so embarrassed. Sometimes the people go up there and they don't ask a question. They just talk about themselves for like 5 minutes, and then they end
hmm
it, and there's not even a question in there. I don't know. Is there a way to stop that, or because I don't know. I have a feeling. I think of Berkshire Hathaway and a lot of investors. There's a lot of alpha personalities that
hmm
kind of want to get their name out. I don't know if did you notice that there?
So back in the day, also as far as podcasts go, Berkshire Hathaway has the archive that you can listen to all the annual meetings. I think from 1991 they started recording till today. So you can also listen to all the questions that were asked over the past 20, 25 years.
Oh wow.
But yes, back then there were times when a question would go on for 5 minutes, and like you're like, okay, can you please ask the question? Like, where are you getting at? But now they limit it to, I think, no more than 3 sentences, or it's a limited number of time. Like 2 minutes is max that you can be on there. So it's a lot because back then I think it didn't have the 50,000 people that show up today, or 35,000 people that show up today. Back then it was the fanfare was a lot less. I think he was less lenient, but now. I haven't seen it in 2018 or this year. There wasn't anyone who was hogging the mic other than
That's good.
Warren and Charlie, which is what we
That's
want.
exactly. That's a good
Yeah.
rule. I like the 3 sentence rule. That'd be cool.
hmm
But so what kind of relationships have you made from that, or just is it mainly just kind of more inspiration, or have you had any kind of deals come out of conferences?
No, it's mostly friends that
Yeah.
you can reach out to and ask things about, bounce off ideas. Not as much these days. Like it was a lot more back in 2018 because I did meet some people in accounting, and back then I wasn't the best at accounting or didn't understand things, and then they recommended some books as well, including one that your inspiration Preston and Stig wrote. I think it's called Warren Buffett's Accounting According to Warren Buffett, or something along those lines. It has accounting and Warren Buffett in it.
Okay.
So learning from the recommendations that were given and then using those books to improve myself. And also, I forgot to mention the other best time to network is when we're standing in line. So on Saturday morning at the shareholder meeting, we get there at 5 a.m. because the lines start forming, and you actually get in at about 8 a.m. So you're literally standing there with other people, and that's where you get to learn more about which books would you read, would you recommend, and that's, I think, is the bigger component, is learning about what other people have to say and what would they recommend as far as what's most valuable to them, and then kind of pass on to me, and then I learn what they have to say. So I'd say like the recommendations would be the biggest component, and then meeting people is always a plus, because it's hard. Like it's just amazing. Like I can say that I know people in Brazil who invest in Brazilian companies, and I can reach out to them right now if I'd like. And it's I don't know. It just closes everything down so well that it just feels like the world's at your fingertips when you go to the conference.
I'm always really impressed with the international travelers, because I mean that they're taking that's a large chunk of change to go to a different country to meet people at a conference. So I think that's pretty cool.
Right.
And now we have Twitter. I don't know if you're on Twitter. Are you on Twitter?
Not really. I think I opened one in high school and never looked back. So I may be there, but go ahead. Sorry.
I love Twitter for the amount of it's just people. You can learn all about what different people are doing, and from all over the world. And yeah, Preston's kind of a fun follow, and see all these charts that I want to understand one day, but see his analysis on that kind of stuff.
Right.
So how did you get into starting an LLC, the Superior North? Because that was, I feel, you didn't have that in college, I don't think.
No, I didn't. So luckily I took, what was it called? Lean Startup in college.
Is that after the book?
One of my management classes. Yeah, by Eric Ries as well. Yeah. So we actually went through the book as well, but it was also offered in Macombs as an undergraduate management class. And so in there, the professor taught us, okay, these are how you can protect yourself from liabilities and blah, blah, blah. And this is how LLC is formed. Pretty much he took us through the journey of how do you start a startup? How do you get traction? How do you test? It's that build, measure, learn loop, and how to pivot and all of that. So it was an amazing class, very practical. So that's how I learned, okay, this is what an LLC is. This is the purpose of it. This is what it does. This is how we set it up. And back then, it was I just had a sole proprietorship with the what's it called? More or less, that's how I ended up getting in-state tuition, because I was tutoring on the side along with my mother, and so that was the initial business aspect of everything that I had. And then eventually, once I graduated, I was like, okay, I don't want to keep it under sole proprietorship because of the liabilities associated with everything. I ended up moving it to LLC, and then I ended up writing blogs, and everything was tied to the LLC, everything that I created. The first 2 years I was writing blogs, and then I eventually got into creating YouTube videos. But everything's is now under the umbrella of Superior North LLC, and also sell jewelry on the side. And that's one of the things that I learned back when I was in high school, and I just continued that through. So it's just, in a way, everything that all my interests are tied to one corporate umbrella of Superior North LLC.
That's awesome. So are you not from Texas? I didn't know you weren't from Texas.
Yeah, I'm from Minnesota.
Oh yeah. Okay, Minnesota.
Yeah.
When so what did you said you were working with your mom there? What does your family think of you're electrical engineer, you're doing well there, dominating, and then they see you go off and doing all these other avenues that you're interested in? You got a lot of support, or has it been kind of some pushback? Like,
no, it's I think electrical engineering was the best decision that I could make. First semester, even through college, it was crazy difficult. Some of the classes were definitely hard, to say the least.
The curve helped a lot.
Exactly, riding the curve. But my dad's an electrical engineer as well, so he was able to sympathize with me with some of the grades that I got. And then with power, even when we took electromagnetism together, and then when I took motors and drives, those classes, like when I have that realization that, oh, this is how motors work. This is how my garage door opener works. This is how my dishwasher works. This is how a fan works. Like it kind of like, oh my gosh, like everything's around me. Everything's a motor from like, it was just amazing to me. And the first 4 years after college, the focus was motors and drives, what I did in electrical engineering. So I'm glad that I became an electrical engineer. I still am glad. And as far as business goes, I was always inclined towards business. And then when I was having conversations with my dad, and he said that you can always become a businessman later on or pursue something in business once you become an engineer, or once you get an engineering degree, or whatever it may be, your technical pursuits. But it can't be the other way around, where you get a business degree and then get an engineering degree. It doesn't work that way. So they were always supportive with my choices, and I'm glad that I ended up becoming an electrical engineer.
Yeah, that sounds perfect, because really with that electrical engineering degree for bachelor's, I think people know that, hey, you can solve problems and you have like a rational mind, and that can be translated. But I couldn't imagine trying to learn what we were doing. I mean, it's definitely possible and people do it, and that's great. But doing it at 30 is a lot more difficult, I think, than in your early 20s. But
Right.
that reminds me too, is like I think having, a support group and people that like encourage you is really cool. And like you said, the perseverance type thing. I listen to a lot of Gary Vaynerchuk, and he says, he wakes up every day just checks his phone, and then he's thankful that all the people he loves in his life, no emergency calls or anything like that, and that's a win.
Right.
So I don't know. I always love hearing those types of stories, and it's irritating when people are just kind of pushing everyone down. And so also, so you're doing all this, the blogging, you're doing videos, you're working a full-time job, and you decide, I still want to learn some more. I'm going to go sign up for an MBA. What has been your experience so far doing the MBA?
I really like some of the classes that I'm taking. I think it helps me make better content as far as videos are concerned. Because when I take my valuation classes, or when I'm taking things that are finance related, I think I'm doing a better job at applying those concepts to my videos. And it helps me out, not necessarily, getting a job later down the line when I graduate, but also I'm able to create better content. And I think one of the bigger components is the more videos I create, I sometimes feel that when I do my research, I'm getting better at, whatever topics it may be. It can be about a certain business, certain sector. Oil and gas always fascinates me. And then using the analysis, the tools that I learned in business school, applying them to the things that I see, the financials that I read, definitely helps. And then having the background that Warren Buffett has, like when to call BS on certain things that the business schools teach, which don't necessarily jive with the value investors' thought process. And so it's fun to finally come across things that Warren Buffett says, look out for these when you are in business school. And, they're going to teach you, and the best thing you can do is learn about it and move on. So, yeah.
So did you think about finance at all, or was it MBA the whole time?
What do you mean by?
Because you could get a master's in finance, right? Like specifically finance.
Yeah. I wanted a MBA because I think that I may want to get into more on the project management side of things, or where I would still have the technical roots, but also more on the managerial side of things. And then as far as my interests go, I'm still going to specialize in finance. So it's an MBA with a specialization in finance.
Yeah, I think that's what I'm applying to MBA, and I think the same thing. It gives you that great or it seems at least to give you a great overview of the whole, how a business should be run and what a good business looks like. And then, so the other thing I wanted to cover is your outlook on the macro environment moving forward, and also bonds. Like no one ever
Hmm.
talks about bonds. How would
Right.
you work bonds in a portfolio?
Hmm.
And is that still going to hold true here in the next 5 to 10 years?
Yeah, that's a good question. If only I had a globe that I can look into and give you a definitive answer. So I think the bigger concept to realize and understand is interest rates play a big component or a big part in all the asset prices. It can be, real estate, bonds, stocks, everything is tied to interest rates. And Warren Buffett says that interest rates have the same effect as gravity has on us, where it pulls down the asset prices. So when interest rates rise, it's a bigger drag on asset prices, which is what we're seeing now when the Federal Reserve is raising interest rates. It pulls down the asset prices, which includes housing, real estate, uh, bonds, all the other assets, gold, Bitcoin, whatever you want to name, everything's tied to interest rates. So when it comes to when it's a good buying opportunity, it's it's a known fact that the higher the interest rates go, the lower the bond prices will be, and that's because interest rates and bond yields go hand in hand, and bond yields and bond prices are inversely related. And all that means, without confusing you too much, is let's say the Federal Reserve right now says, I'm going to charge, or we're going to raise the interest rates to 3%. The 10-year treasuries may yield 5%. And what that does is, let's say before the Federal Reserve came and announced the 10-year treasury may be yielding 3%. But in order to give you that 5% return, the prices have to come down to give you that 5%. So even in the bond market, it's still supply and demand, where the 3% yielding bond before the Federal Reserve came in and said, oh, we're going to hike things up. The demand for that has dropped. No one wants to get that 3% because now you can get a 5% return on the bonds. So the best way that a 3% can become 5% is if the bond prices for that 3% go down. And when prices go down, now you're going to get a 5% return. So that's what we're seeing now is bond prices going down, and in order to get that yield that comes with rising interest rate environment. Did that answer your question, or not really?
No, yes, that's good. I mean, a little over my
Okay.
head, but I should know.
Okay.
And then, so what I've seen is, the Fed is worried about inflation, and so that's why
Hmm.
they're raising interest rates to
Hmm.
slow down inflation. Like you said, when you raise interest rates, that's it contributes to like kind of a recession environment. And then everyone, I mean, it seems like at some point they're the economy is going to be bad, and they're going to go to QE, or quantitative easing. And
Hmm.
so my understanding, please correct me if I'm wrong, but they buy back government bonds, and they're just kind of just printing money into the system, and which ultimately devalues the dollar and the purchasing power. So inflation would continue to rise. I don't know. Do you see the inflation ever coming down anytime soon, or what's your outlook on that?
Yeah, it's I don't know like how it's all going to turn out. The best thing that we can do is protect ourselves by having inflation hedges, stock market being one of them. Um, it's and you're correct that the quantitative easing creates inflation because that's the scenario that we're in, where there's a lot of money that's created and it's chasing just a few amount of goods. So the prices for those goods go up. Again, supply demand, and how that relates to prices, where you have abundant amount of demand trying to chase a few amount of goods, which drives up prices, and that's what inflation is the rise in prices of goods. Um,
Using the
and
CPI or whatever, Consumer
mhm,
Price Index.
Yep, with all different baskets of goods that, depending on how much of a demand that's creating, everything's going to go up. Is what I'm trying to get at, up to some regards, because of demand for those goods. And the what Federal Reserve can do, they have two things in their power. One is interest rates. There are only two tools, even though they always say that we have a bunch of tools that at our disposal. It's either increasing or decreasing the supply of money and increasing or decreasing interest rates. Those are the two tools that they have that they can play with in order to overheat or overcool or to keep the economy in balance. And their mandates is to have low unemployment and stable prices. And those two are their mandates, and usually they contradict with each other because when they try to cool the economy down, it kind of drives up the the unemployment. And when they try to lower the unemployment, it kind of heats up the economy. So they're always playing this game where trying to balance the seesaw to the best they can. So we went through the quantitative easing phase where they printed a bunch of money, bought a lot of assets, and now they're essentially reducing right now they're increasing the interest rates, and that doesn't motivate companies. That kind of takes them away from taking on debt. So for example, if say Apple or Tesla wants to buy a new factory or invest in a new factory, they're no longer going to do that because now the interest rates are at 5%. 6 months ago it was at little to 0%. So the cost for them has grown dramatically. So now they're no longer going to invest in that factory, which may have employed more people, increased the materials or goods or whatever the demand may have been, employed more people, whatever. That's not going to happen because by increasing the interest rates, they're cooling down the economy. And when the economy cools down, what happens is we're not going to be spending as much money because we start becoming savers. And the supply and demand characteristics, even though they have not necessarily done quantitative tightening, they're at the beginning phases where they are letting the balance sheet run off. They're no longer buying securities. The supply, demand, and price characteristic is inverted from where it was 6 months ago, where now the supply may be still there or slowing down. The demand is definitely slowing down because people are no longer wanting to buy, and that eventually, if economy or the economics works, should bring down the prices of goods. And then you're always going to have the supply and demand disruptions all across the globe, which sometimes spikes up prices, which are out of the Federal Reserve's control.
And it seems like such a complex problem. And
Mm-hmm.
I personally, my opinion is it's kind of crazy that we have this system and we don't have as like I thought when we went off the gold standard, I thought that was a huge mistake. Like how can you use everyone using the same amount of money, like they can know exactly, this is set, this is what this is worth to me at this time. But then if you have a money supply that keeps going up, now you got to worry about inflation and okay, I need to spend now because I'm disincentivized to save, or I need to invest. And it almost is like we shifted to a purely Keynesian economic view where in my thoughts on this, I definitely need to read more, but overview, it seems like for Keynesian economics, they think spending and consuming is kind of leads to producing. Like they want to stimulate things, and I think they're putting the cart before the horse, where you have to produce before you can consume, and that's why I think the Austrians have it a much better take. I don't know if you agree there or not, or if you have any thoughts.
I don't know too much about the Austrians. You'll have to tell me more about them, or I'll have
definitely
to,
like gold standard and free market, big, laissez-faire, free market. No, like subsidies are not, it's not a free market if you're having subsidies or if you're, like giving out money. It totally throws off the actual, like what, I think of like A is A. This is existence exists. This is what the market is saying. But if you have all these subsidies and tax breaks, tax benefits, it's hard to get the whole picture and make a rational decision.
Right. I agree. I'm more like I said earlier, right? I'm more on in the Adam Smith camp of things. I want to let things work out by themselves, little to no interference with everything that happens. But at the same time, that's what happened during the Great Depression, where they weren't decisive enough to act, and that prolonged the recession, leading to the Depression. So, in order to spark things up, juice things up, I think up to some extent, it's necessary that the Federal Reserve steps in, provides the liquidity that's needed to jumpstart the economy. But I wouldn't agree with the fact that you need to be at it for 10, 20 years at little to no interest rate. Now, that's excessive in my regards, which is what the Federal Reserve did after 2008. It took forever for them, and now it's the first time in 6 months, or it's the first time that the interest rates are this high in 20 years. So I think once that economy has jump-started, the Federal Reserve has to then take itself out before the economy gets too used to that conditioning that the Federal Reserve is always going to be there. They're more or less there for the last resort, but today it seems that they are the only resort up to some extent.
Yeah. And I think that's still under debate too, like the whole Great Depression. I heard a lot of economists either saying all the government interventions and actions they took actually delayed the recovery. And the big thing I think of there is like unemployment is always like, so the Fed is huge about unemployment, but you got to be careful because our government, like we can make jobs where, okay, we'll spend this much money and give, thousands of jobs to these guys to go dig holes in the desert. And okay, they're employed, they're getting money, but they're providing no value at all.
Right.
So, but unemployment goes down.
GDP.
Yeah. So I think that's what I'm skeptical about. I think there's a lot of stuff that we do as a country that is that is just being propped up because, you're getting those funds, and it's like zombie companies that just kind of drain the whole economy as a total, even though, okay, employment might be a little better. I don't, it's very hard for me to see how there's any moral stance for that.
It's the same thing, right? If you have too much money, it's gonna go into all kinds of places like SPACs or things which the society may not deem as essential, but there's money here, like where else to put it. So
just like crypto.
That's how speculation. Yeah, sure. That's how speculation starts. And if the liquidity wasn't there, if it was, then it would be truly going to things that are important to people, not necessarily speculative bubbles that end up happening because of a lot of money that's around circulating.
We just gave like $2,000 in every 20-year-old's pocket recently, and they went out and bought a ton of shit coins, and that crypto market just exploded, and then everything comes back to reality. And was there any value in all that kind of stuff? It's just wasted away, and I don't know. It makes it very complex, it seems. So those were all the questions I had. I wanted to ask you, is there any things you wanted to plug, or just any advice, last save rounds for value investors, or people that may be listening?
Value investors, let's see. I would definitely recommend checking out Warren Buffett, Charlie Munger, Benjamin Graham, Lee Liu, Monish Pabrai. There's some famous value investors. Can definitely learn from their mistakes, their approaches. I'm still a rookie, trying to learn more about value investing, but I found those 5 people to be very valuable as far as their teachings go, their talks, their interviews on CNBC or just on YouTube, or the things they write about, annual reports, and it's an ongoing process. Value investing is you never are fully there, and having an open mindset that you're always trying to learn something new because you never know when whatever you learn can be applied to an investment that you may make later down the line. That thought process is critical for value investing, is constant knowledge acquisition. So, but yeah, those
Well,
5 people, definitely check them out.
yeah, thank you so much, Vyom, for giving the listeners a little introduction to value investing. Make sure everyone go and subscribe to Superior North LLC's YouTube channel, their email list on the website, and so you can stay up to date with all that Vyom is recommending and analyzing. And this is episode 4. Thanks, Vyom.
Thanks, Mike, for having me.